I'm Lauren Stone with Welcome Home Real Estate Group, and I'm here with Scott Spieker from Prime Lending.
Hey Lauren, how are you?
Good, how are you?
Good.
Good. Today he's just going to be explaining a little bit with the lending process. Can you tell us a little bit about yourself and how long you've been doing mortgages?
Been doing mortgages for a little over 18 years now. Love what I do. We've been through some hard times in the past with the way lending has gone and kind of the mortgage fallout, but the key thing is just really I love helping people get into this. I've been a lifelong resident of Kenosha County. I've been doing loans in Kenosha and Racine for those full 18 years, so I know the market really well.
Can you tell me what type of loan programs are available to buyers right now?
Yes, some of the biggest are your conventional. So we have conventional, FHA, VA, and USDA. Those are your main types of mortgages right now. Those are all called conforming mortgages. Conventional is more for your experienced buyer, maybe someone who has a little bit more of a down payment. However, conventional can have as little as 3% down. There's many first-time homebuyer programs, and these are dubbed first-time homebuyer programs, literally because it requires less money down. They're actually more advantageous even compared to a 5% down because you have a better rate. You're going to get a better rate. Your mortgage insurance is going to be a little lower. Mortgage insurance is something that's on a loan for anyone who doesn't put 20% down. Getting to that 20% down, there's a big myth out there that a lot of buyers think they have to put 20% down. That has not been the case since the early 80s, really. We have so many people that come in and say, I'm just getting ready to buy a house, but I don't have 20% down yet. There's really no big advantage to putting 20% down besides getting rid of mortgage insurance. When I have someone who's got 20% down, I still give them the options, okay, we could do 5, 10, or 15. The reason being is every $5,000 on a 30-year mortgage typically only equivalates to only $25 a month. It doesn't make that much of an impact. So sometimes I'll have people say, okay, well, maybe I'll put 10% down instead of 20% or 5% down, and then maybe do some renovations to the house right away. Maybe do some siding, upgrade the flooring, things like that, kitchens, bathrooms, very common. The first-time homebuyer programs with the conventional are restricted to income limitations, but it's still a pretty high income. Generally speaking, in our area, it's about $80,000. Then you have FHA. FHA is another common first-time homebuyer program. Going back with that conventional, FHA and conventional, these first-time homebuyer programs don't necessarily mean that you have to be a first-time home buyer. You typically just can't have another home at the same time. So you could literally sell your current home and get into the next home that same day. You just have to sell your current home first and you qualify for these programs again. FHA is more of a forgiving type of loan. Forgiving meaning they are going to be a little more lenient on debt ratios, so maybe qualify for a little bit more as long as it's still a comfortable payment for you, but they're also going to be less restrictive on credit scores. That's probably one of the biggest factors of why we will go FHA with people is because you don't have to have perfect credit to buy a house. You just have to have decent credit. That's where FHA comes into play. It's been around forever. It was set up by the Federal Housing Administration to help first-time home buyers. It was set up to help people get into these homes a little easier than your conventional type of loans. Federal VA, you do have to be a veteran. If you are going to have another person on that loan, that person actually has to be your spouse. One of the people have to actually be a veteran. That's the key thing. And that program is probably one of my favorite programs. It's a well-earned, well-deserved program. It is literally the only true zero-down program left. VA does charge a VA funding fee, but if you receive any kind of VA disability, that funding fee is waived. VA loans are just fantastic for that. And again, it's set up to help that veteran who helped us so that we can help them.
And do you have any advice from your perspective on how buyers can work with lenders more effectively throughout the loan process?
That is a great question. What a lot of buyers don't know is what we are looking at as lenders when we do an application. Ever since we kind of had the mortgage crash between 2009 and 2013, a lot of rules have changed, a lot of them for the better. We're making sure that doesn't happen again. So we are going to look at your job history. You don't necessarily have to be at the same job for 2 years. You just can't be job hopping every other month. That's something.
Would you say is best at most? to
Best
start?
best scenario is at least 6 months. If you're in the same field, you could actually start a new job right before you apply for a loan, and you would qualify because you're in that same line of work. And then what we're looking at is where your down payment's coming from. There are a lot of anti-money laundering regulations out there right now. So we are going to watch where all your deposits come from. So deposits from your employer, totally fine. Deposits from tax returns, totally fine. Taking money out of a 401k and using it for a down payment, we can track all that. The worst thing a buyer can do is put cash into the bank. Cash is like a very bad word in our industry. Typically cash, in order for us to be used, we actually have to have it seasoned for at least 60 days. So when we take in an application, we're going to look back 60 days. If we see cash deposits go in there, we actually can't use them. Now, gifts are allowed on pretty much every program between your conventional, FHA, VA, but we have to document the gift. The gift source typically has to be from an immediate family member. What we do is we have them sign gift letters, we make copies of the checks, and we keep track of that. So the biggest thing I really want to stress on this part of it is not putting cash into the bank. The credit history, if you are getting ready to buy a house, you don't want to go around applying for multiple credit cards. Credit cards are unsecured debt and actually will lower your credit score. Mortgage shopping, there's a big myth out there. Like, if a lender tells someone that, pulled your credit, you don't want to have any other lenders pull your credit, that's actually a myth. The way it's set up right now is you have up to 3 pulls within a 60-day period where it's not going to have a negative impact on your credit because they want you to be able to shop around a little bit. So that's a big, if you hear that, that's kind of a red flag from a lender. But credit cards, probably the worst time of the year is Christmas. When people go shopping, they'll go through a department store. The department store will say, hey, do you want to save 10% today by applying for this card? Well, it's happened where we've actually had to disqualify people because it lowered their score too much, just to save 10% from a $25 purchase. So that's a big thing. You don't want to go around applying for unsecured debt such as credit cards. That's really about it. That's kind of the big things we look at is job history, where your cash to close is coming from, and credit. So you really want to watch those things if you're preparing to buy for a house. If you're self-employed, a big factor here is we know that self-employed people like to write off whatever expenses they can so that they don't have to pay taxes. What self-employed people have to keep in mind is that we have to use what they show as net income. So they could show $100,000 a year in income and have $95,000 in expenses. Well, that means that as a lender, we're using $5,000 a year as income. So that's not going to help them. So if a self-employed person is getting ready to purchase a home, they need to get with a lender. They need to actually figure out what they need to show on their tax returns and be prepared to actually have to pay a little extra in taxes if this is where they want to go with it.
Can you better explain the closing process to a potential buyer when a loan is involved?
Absolutely. So what we're going to do is, of course, we're going to have you pre-qualified before you go looking for a home. That's probably one of the biggest things is you do want to get the buyers pre-qualified before they go looking for a home, because one of the worst things is having a buyer going out, finding a house, falling in love with it, and then have them come to me and tell them, I'm sorry, you're not going to be able to get that, but we can get you something a little lower. So getting pre-qualified is huge. So we get that, we get an accepted offer in place. Once you find that right home, then what we're going to do is we're going to start collecting more documents. We're going to look at your last 2 years W-2 statements. We're going to need your last 2 months bank statements, last 2 months pay statements, and basically put all those factors together. Then I work with a processor, which my processor is fantastic. We will work together. So you actually not only have myself, then you actually get a processor who is basically like my backbone. We are going to work with that buyer, bring them through this whole process, order the appraisal, get the appraisal in, make sure everything is good there, get all that together. And most of the stuff actually these days can be e-signed, so it's actually very easy to get things done. We don't have to actually have ink signatures on many documents anymore. We get that, put it all together, and then we send it off to the title company. The title company gets some seller's figures. We bring it in, put our figures into it, and we disclose, okay, this is how much you're going to need to bring into closing. go to the closing, and closings can typically take anywhere from a half hour to an hour. The biggest thing I want people to understand when they go to the closing table and that title company is going over the documents with them is if they have any questions, you should ask. This is a huge investment, whether it be a $40,000 house or a $400,000 house. You know, if you have questions, you should ask that title closer at that time, and always feel free to ask the lender during the whole process. The biggest thing is just being able to understand it and having the knowledge of and knowing what you're getting into.
And what is your opinion on the local market?
The local market is very strong right now. You need to go in strong with your offers. So if you, in the past we used to actually ask people to, okay, you know, here's the sales price, but we want you to have the sellers pay $3,000 or $3,500 towards prepaids and closing costs. That's fine, because some buyers actually do need that money, but they have to realize that it's that much less money that the seller is going to get.
Right.
So with the competition in our market right now, being so, I guess, what's the word you want to cut through? Maybe, yeah. Well, basically just not having as much inventory as what we need out there right now. You want to take your offer along with the other 3 or 4 that might be coming in within that hour and have it be the most clean offer. So as a lender, we're always going to try to get you into a conventional loan. Conventional loan is going to be a little more solid to a seller. FHA is fine in most cases. There's a big myth about FHA that it can be a pain with painting, roofs, things like that, but rarely do we really see that anymore. It's really just going into it clean. There's a lot of times now where someone has a house to sell, and if you go into an offer with the home sale contingency, even if it was apples to apples, you had one offer for this much and another offer for the exact same amount, but this person doesn't have a house to sell, the seller's going to take this house more than likely. Not all the time, but more than likely they're going to do that. So lately what we've been doing is qualifying people for 2 mortgages, knowing that realistically once they sell their house, they're not going to have a double mortgage payment. So as long as they price their house accordingly with the realtor, they're going to be able to not have to worry about that 2-month, you know, that having the 2 payments in a month. That is a big key factor. So that is more common than anything. We've seen people taking out short-term loans from 401k, and then once they sell the house, putting it back into the loan, or you know, not having that extra debt and reinvesting in their 401k. We've seen anything from bridge loans, where you're actually just doing like a home equity line of credit to take the equity out if you have it, to be able to do that. And then if you do sell your house, and you can get in, again, you can get into this new house with this other mortgage already with as little as 5% down. Very common these days is once people do sell their other house, let's say it doesn't sell in time prior to their new closing, you can do what they call a one-time note reduction. So as long as it's 10% of the balance of the loan amount, you can actually have your note rewritten, put that money in there, and actually have that lower payment as if you would have had if you would have sold your house. So long story short, these days with the market being as competitive as it is, we have to be very sharp with what we're offering a seller on our buyer's side.
Okay. And on average, how often do you think it takes for closing nowadays?
On average, right now I'm at 26 days. Ideally, we like to see 30 to 40 days. We can do things very quickly. One of the things going back to, you know, what to expect from a lender, things always move along very smoothly as long as we have a buyer that responds quickly. So responding to your lender is very, very important. If we ask for something, you kind of want to get it to them yesterday type mentality. We can get loans closed in as little as 3 weeks, 2.5 weeks even recently. But that was a buyer that was, you know, I said, okay, we need to get this, this, and this. I had it. That is key because we are still waiting on other entities. Title still has to be prepared. We have to have an appraiser go out there. Appraisals can take up to 10 days. Inspections, inspectors are busy too, so that can take up to 10 to 15 days right now. So there's things that take time. On average, I would say a 30-day closing is really the average. Ideally, 40, but it can be done. Buyers just have to be very responsive, and you have to have a lender, such as Prime Lending, who really stays on top of things and gets the documents and processes that loan quickly so we can get you to that end goal of owning the new home. I want to wrap this conversation up with saying, feel free to contact me. My number is 262-818-1655. We do work 7 days a week, so we are always available. And contact me for a free pre-qualification. It doesn't cost you anything, there's no obligation, and it's just good to know where you stand. You'll see commercials on TV, you can get pre-approved in 5 minutes. I'd be a little leery of that. You want to work with someone local so that they know the local market, they know the title companies work, they have local appraisers. That's a big key thing. But again, just feel free to have people contact me, ask any questions they have, and I will get them into the right direction.
Great. Thanks, Scott. I appreciate it.
All right, thank you, Lauren.
If you're in the market to buy or sell a home, I would hope you choose me as your real estate agent so I could be the one to help you on the journey to finding your next perfect home for you and your family.